from the CNBC-TV18 Motilal Oswal studios in Mumbai.
Good morning. You're with us here this Friday morning on a fresh new edition of Bazaar Morning Call. We are coming to you live from the CNBC-TV18 Motilal Oswal studios. I'm Prashant. With me, my colleagues Surabhi and Mangalam. Guys, hi, good morning. If you were hoping, at least I was when I woke up this morning, hoping for a nice, quiet Friday after a pretty tumultuous week. It's not to be. I mean, I think I can tell you that. It's not going to be a quiet day.
I completely take the blame for that, because the last two times I've joined on a Friday, the news that we had were worth 2-3 Mondays, and that repeats today as well.
I think so, and that really makes it two of us. I really thought, okay, fine, big week, and now we're having a quite nice end to it, not much happening with the market. But no, there's always something happening, and this time I think a lot of it has to do with New Delhi.
Absolutely, and people may be wondering, because we kind of caught on to it late last night, early this morning. Yeah. What are these guys talking about? I mean, US markets are up and things are looking quite okay. It's the flashes at the bottom of the screen, which we will discuss in greater detail. That is the big one. It's a big sort of blow for the debt mutual fund industry. As I said, more in just a bit from now. But, first things first, right? We take off from where Wall Street left off yesterday night. So let's get that going. So decent rally in U.S. markets. NASDAQ is up 1% on your screen. U.S. Treasury Secretary Yellen, who caused all the damage the day before yesterday, spoke again, but with a slight modification, which helped sentiment. And she said, and I quote, "Certainly, we would be prepared to take additional actions if warranted." This is with regards to U.S. banking deposits. And, this was much more helpful. This was much more constructive. She said a few other things, but nothing which was construed to be negative. Now, markets kind of picked up. It was a late kind of pullback in the U.S. indices as well. The U.S. 2-year sank about 13 basis points. The 10-year saw a 1 basis point fall. But the 2-year, which is the most sensitive to any changes in Fed interest rates, etc., that sank 13 basis points. So the market, at least the rates market in the U.S. is telling you that it was indeed a dovish Fed. Yesterday, a lot of people were saying, well, if the Fed was dovish, even with a 25 basis point hike, why did the market sell off? The rates market 1 day later is telling you, well, it indeed was a dovish kind of Fed. Maybe we'll worry about why they were dovish a little later down the road, but for now, that's the interpretation. Thursday session, quickly coming to the market here. Thursday session was disappointing. We saw a late sell-off. The market actually, opened strong. We saw a sell-off. For 3 or 4 hours, that was absolutely flat. And starting 2:30, we saw that big crack. Now, the immediate resistance for the Nifty is become 17,207. And the 20-day moving average comes in at 17,304. These are the very near-term immediate resistances. On the way down, 16,975 and 16,828 are important levels, which should be defended. So that's the near-term kind of trading setup. If you're trading, these are levels which become very important. Now, on the bank Nifty, it was disappointing because we hit the 20-day moving average. The high point was almost not almost, we actually crossed it intraday and then sold off. So touched 20-day and then sold off and posted a sort of negative close. On the way up, the 20-day becomes important, which is now at about 40,154. That is the resistance. It's very near term, but we are in that kind of a market. And on the way down, the low of 38,941 will be important to hold. So these are interesting levels and important levels if you are trading very near term. The SGX is indicating a flat kind of a start, something what we were seeing yesterday as well at about 17,059. But let's from global get to the big story, which I think we'll discuss with experts, etc., in a bit from now. The amendments to the finance bill with regards to debt mutual funds. Surabhi.
Prashant, yes. So I thought I'll talk about Accenture's result and, so on and so forth. But let's forget that. Let's talk about the hot news at the moment. Yep. So first of all, this is still within the realm of course, conjuncture. It's a lot of conversation, chatter that's doing the round in tax circles and mutual fund circles. So that's the first caveat. You have to take that on board. Now, what the chatter is suggesting is that, we were going to talk about insurance. Insurance was supposed to be the big one, that will we get an amendment which gets a relief. The industry yesterday was talking about maybe that cap, the taxation cap being lifted from 5 to 7 lakhs. But move over insurance, the hot subject this morning is mutual funds. And why do we say that? You remember, go back to, the budget day, market-linked debentures were given a bit of a tax hit. Up till now, market-linked debentures were getting equity treatment because a lot of them were being redeemed just, after a year. And then you had that 10% capital gains tax with the benefit of indexation. So in the budget itself, the tax regime for MLDs was changed, which was a big hit. However, what is happening today, according to a lot of these sort of, circulars that are floating around, is that it seems that the tax regime will be changed not just for MLDs, but they have added specified mutual fund to the definition. So it's MLDs and specified mutual fund. So what is the specified mutual fund? Well, a lot of this right now seems to be pointing to any fund that has less than 35% equity. So as long as the fund has 35% equity or more, it gets equity taxation. If the fund has less than 35% equity, then it gets, clubbed in this new category, and it basically loses indexation. And that is why the industry seems to be up in arms. Everybody is up looking at their phones right in the morning. Because if this comes through, then we're talking about debt investments getting hit. Remember, debt funds right now get that benefit of indexation if you hold them for 3 years. If that's taken away, what is short-term capital gains tax? Essentially, it's taxing you at the slab rate minus the indexation benefit. And that was very, very important for big funds like the Bharat bond, etc. So debt as a category, we're also talking about gold funds. We're also talking about foreign equity funds, because the definition right now seems to be suggesting only domestic equity, 35%, but in domestic equity. So we have to watch out for how this plays out. We'll, of course, get a lot of experts, tax experts, industry representatives to talk about this. But yeah, the finance bill will keep things
just
hot.
2 points to this. So anything, the thing says that after anything invested after the 1st of April 2023 will be subject to this first, right? So there is no retrospective or anything, but 1st of April onwards. It says that if you invest in debt funds and when you sell, that income will be added to your income, right? The gains will be added to your income, and you'll be taxed at the marginal tax slab, which, as you said, whatever your slab is. That is the change which has happened. The question now is, does it kind of almost make this entire category completely unattractive? And if it does, right, when we talk about asset allocation, experts come on and say, well, have money in debt, have money in equity. Debt funds is a very important, large route through which it happens.
What my curious question was, I was just looking at some data, and you guys have been tracking this for a very long time. The average assets under management for the Indian industry right now is close to 40.7 lakh crores. How much of that is debt? How much of that is equity?
40,000?
40.69 lakh crore.
I think the debt number would be very large. I'll have to get
I think it'll be larger than equity.
I think so.
It will be larger. Though debt funds have been seeing a lot of outflows off late, but that's more because of the nature of the market and the way interest rates are moving.
The question is where will this money go?
If it goes into equities, then...
So what? Two things. One, the tax, because people look at post-tax returns, right? It becomes at par. Post-tax returns become almost at par with FDs. So it could be very positive for banks, number one. And second, will we see some of this money coming into equities? It's entirely possible as well. Although, the basic tenets of asset allocation, etc., stay right there. It's just that the category, debt mutual funds as a category, becomes far more attractive starting this morning, starting the 1st of April as compared to before that.
All right, so we will monitor this, and we will obviously have a lot of conversation around this, but let's then stick to the basics right now for the market itself. The SGX Nifty, like Prashant said, is indicating a flattish start, a mild negative, but the good part is it suggests a start right in the support zone. The good part is that over the last few trading sessions, if you look at it, the Nifty support has moved higher from 16,850 to close to around 17,000 to 17,050. Why do I say that? The last 3 trading sessions, the Nifty has bounced right back from 17,016, 17,108, and yesterday's low was 17,045. And looking at this, the FIs were tremendously short on the index futures, has perhaps after a very long time made their first purchase in index futures, 1,000 crore worth purchase, and 60% of that was allocated towards the Nifty, only 40% that to the Nifty Bank. And the Nifty Bank has been an underperformer. We'll talk about that as well. The FI has added 8,500 long contracts, covered a few short contracts. So from tremendously short positions of almost 92.5%, from 7.5% long positions, the FI longs have inched higher to 11%. The Nifty Bank hit the 20-day moving average yesterday, like Prashant pointed out, but fell from there and fell below the 200-day moving average of 39,717 as well. So that is a weak index right now. What could support the Nifty and what explains the higher allocation of FIIs towards the Nifty than the Nifty Bank? is IT. Nasdaq did well yesterday. Fed rate hike cycle nearing its end. That's what people are assuming, and as a result of which, bidding all the tech stocks up, and then Accenture's numbers as well, which we will talk about. The only fly in the ointment on the way up, we have stiff resistance at 17,200 upwards, because twice in a row, on 2 consecutive days, the Nifty has faced resistance upwards of 17,200 in this month itself. One was on March 14th, one March 15th, and then March 22nd and 23rd, which is yesterday and day before yesterday, where levels upwards of 17,200 were strongly negated. So that's something we'll watch out for.
Absolutely. I take your point. I think IT could be a sector to watch out for, because before a lot of this hit us, Adani, global issues, IT was the one pocket of the market that was doing well in tandem with US IT, though of course companies are very, very different. And we've seen that buying return on Wall Street, at least with the big tech names.
The only counterbalancing to that would be the fact that, we have a larger exposure to BFSI, which is not doing too well.
Yeah.
And secondly, the fact that Nasdaq rallied because of Apple. Apple is looked at more as a consumer company than a tech company. So will that correlation work 1:1? We don't know yet.
Well, let's see. Stocks are beaten down. We'll find out. Let's straight away take it to the equity call of the morning then. Christopher Wood of Jefferies says the valuation differential between India and China has reverted to its traditional mean after the huge 65% outperformance of MSCI China over MSCI India since the end of October 2022 to late January following the China reopening. This sets up the potential for renewed outperformance by India in an Asian and emerging market context, most particularly as dedicated long-only foreign investors are underweight India.
Well, let's get you some money market views as well. Bhaskar Panda of HDFC Bank says that several central banks hiked interest rates as expected, but what has caught the eye and imagination of market participants is that the US Fed is around the end of the rate hike cycle. He says this is now reflected in US yields across tenors, and says dollar index remains soft, so as oil and all this is good for the dollar INR, which showed resilience as the pair traded near 82 to a dollar yesterday. He says demand should pick up when the dollar INR pair nears 82. Hence, he expects the pair to trade in a range of between 82.825 to 82.45 to a dollar.
On bonds, Bhaskar says in the Indian bond market, yields have been trading in narrow ranges, and this trend is expected to continue for now. Hence, he's expecting the 10-year benchmark yield to trade in a band of 7.3 to 7.35%.
All right, we will have a lot of stock-specific action to track today as well, so we'll get to that in just a bit in our special top 10 segments. But before we get to all of them in detail, let's talk about what we're talking about. One is Nifty IT. We'll also talk about Campus Activewear. Interglobe Aviation held an analyst meet. Bharat Electronics and Hindustan Aeronautics on order wins. Vedanta is the other stock on our radar on the back of positive news flow. On the way down, we'll be watching out for HDFC AMC, UTI AMC, all the asset management companies, Aditya Birla Sun Life AMC, as well as Nippon Life AMC on the back of the news that just flashed at the bottom of your screen.
All right, Mark Matthews is now joining us. He's with Bank Julius Baer. Mark, great to have you with us here on the program. Thank you very much. First time we're speaking with you after, the Fed decision and the dovish hike is, I think it's now been called. What's your view? Global markets, Mark, which still seem to be in a bit of a turmoil. Go on.
Well, I think that the worry has shifted from inflation to growth, and that is because of the banking crisis. And we can see it reflected in Bank of America's Fund Manager Survey, where for 2 years, inflation was the #1 concern, except very briefly during the pandemic for 2 months. But as of this month, a credit event is the biggest concern. And so that, I think, does change the way the market is behaving. And we can see that in the fact that the big tech stocks are at new highs for the year, but the broader market feels choppy at best because it's weighed down by banks. And I think that it's still okay. I think chop is probably the best way to describe the market for the foreseeable future. I can't really see it collapsing because I don't think the government will allow a system-wide, problem in the banking sector in the United States a year before the election. And at the same time, I do believe that we are at the end of the rate hike cycle in the United States, although they didn't come out and explicitly say that yesterday. But if you look at the Cleveland Fed's inflation nowcast, which is a good track record, it's looking for 5.2% for March CPI. And below 6, I think, would be a very psychologically important thing. So those are some of the things going through my head right now.
Got that, Mark. So what's the stance from here on? Do you think the market will be able to put behind some of these banking issues, given that, we've again got Ms. Yellen saying that they're willing to repeat those actions that they took with SVB? So basically, does the market go back focusing on economy, inflation, corporate growth? Or do you think this is still going to lurk in the background?
I think it will probably lurk in the background because the small and medium-sized banks were exempted from a lot of regulation in the United States to try to foster growth in the economy. And they are a backbone of the economy in many ways. One way is commercial real estate. And, I always find fascinating the second and third derivatives of major events and how we can look back in history and see why they happened. But at the time when the big event is happening, you can't really forecast these things. And so I think with COVID, one of the interesting legacies is the work from home phenomenon in the United States. And it's for real. I mean, office occupancy is only 50%, even, 3 years after COVID, because people tend to live in big bungalows over there, and they have their own nice home offices, and they have to commute a long way to get to work. So they're not going back to work, and increasingly companies are hot desking and downsizing. Now, I'm telling you all of that because the commercial real estate sector, 80% of it is financed by small and medium-sized businesses, and there's about $1 trillion in that debt that needs to be refinanced between now and the end of the year. So just that one little nugget of information alone, I think, is enough to keep the market on tenterhooks with regard to these smaller banks.
Right, Mark, you make us feel terrible on a Friday morning by saying people in the US have big bungalows and big houses, etc. Yeah. We live in our matchbox-sized houses here. Just one question on the emerging market space. The US market's not doing well, developed markets not doing too well. Back in the day, one would say that, okay, developed markets not doing well means it's even worse for the emerging markets. Do you think that narrative changes and the emerging markets, especially India, decouples from that based on its own fundamental strengths?
So it depends on really if the S&P just flatlines, I think that's the best for Asia. And one of the corollaries of a peaking interest rate cycle in the United States at the same time as central banks in other parts of the world are still hiking. And last night you had the Swiss National Bank, the Norges Bank, Bank of England all hiked, and they said they're going to keep hiking some more. One of the corollaries of that is that I believe the dollar should gently weaken, and that, of course, is good for us. So, it's always dangerous to look back on history and find parallels because there's so many variables at any one point of time in the market. But I would say that the early 2000s, after the dot-com bubble collapse, which in some ways is an appropriate comparison, were a very listless, choppy period for the S&P. And that was the beginning of a great transfer of money out to Asia looking for greater returns. And so I feel that to a degree that's an appropriate analogy.
Right. Mark, thanks very much. Great speaking with you. Appreciate you joining in with that. Let's get to the big story for the day, which is, of course, the taxation changes with regards to debt mutual funds. And Radhika Gupta is now joining us. She's Managing Director and CEO at Edelweiss Asset Management Company, somebody who, of course, runs a lot of debt money and is looking at this very closely. Radhika, good to have you with us here. Good morning. This does hurt the entire category immensely, doesn't it? Tell us what do you make of what has been done, the implications, and why do you think this has been done? Go on.
Good morning, Prashant. So I think this comes as a surprise, and it has a very adverse effect, not only on debt mutual funds, but also on some other categories of mutual funds, gold mutual funds, international mutual funds, fund of funds. So the impact is not small, and it's wide-ranging. I would make 2 points here. See, I think it's an unfortunate step, and I think this is a proposed amendment in the finance bill that's going to be passed, and I really hope it's rethought because, as you said, we run large bond portfolios, and debt mutual funds have been an important product for the Indian consumer because finally we are a country of savers, and financialization is just happening. Now, a program like Bharat Bond, which is a Ministry of Finance sponsored program, has seen tremendous success, has hit 55,000 crores in the last 3 years. Target maturity funds are just growing. In fact, debt mutual funds have been able to channel significant amounts of 10-year plus money into the bond market. And I think all of this will be very adversely affected with a move like this. The second thing is, it is important to think about the second-order impacts of moves like this. I mean, India is finally a country that needs significant borrowing because of infra spend. Bond market liquidity and development has been a concern regulators and governments have had. And, to be frank, mutual funds are the significant institutional investors that are not hold to maturity, because all other bond investors are hold to maturity. So I think you also have long-term implications on bond market liquidity and a lot of borrowing then coming back to banks, which is not good. So it's not a good move. I'm surprised why it's been done. And it's also come a little bit out of the blue.
Sure. Radhika, good morning. Surabhi here. I just want to dial back a little bit and go back to that definition, which is, of course, causing, the worry and the jitter. For the benefit of viewers, I mean, we're talking about larger issues which are very important, but for the benefit of viewers who are trying to understand what this potential change could be, could you just go over this? Because now what they're saying is that any fund where the equity holding is less than 35% will perhaps lose the indexation benefit. So that really pretty much applies to the entire debt category, to perhaps to foreign funds as well. Could you just go over the definitions?
It's actually a more tight definition than that. So it's funds with less than 35% in domestic equities, not even domestic funds. So in my understanding, it applies to all debt funds. It applies to gold funds and gold ETFs. It applies to international fund of funds and international funds because they are not domestic securities. It even, funnily enough, applies to fund of funds which are investing in domestic Indian equities, because it's actually a fund of fund product. The mutual fund is holding other mutual funds. So outside of plain vanilla equity and hybrid funds, which have more than 65% or 35% equity, it pretty much applies to all mutual fund categories on a prospective basis, not retrospective.
So what does this mean for incremental flows coming into debt funds? Do they dry up? Where else do they go? I mean, I was just looking at some numbers. We got some data as well. 40% of the current AAUM is in debt funds, non-equity, that is.
Yes.
What happens from here, Radhika?
I expect if this were to be passed, the money that comes into debt funds over 3 years, where you enjoyed the tax advantage, may look at other alternatives. It could be listed bonds. It could be FDs again. And it's a question of how many options there are and who migrates to what options and what absolute yields are. Money under 3 years never enjoyed the tax advantage. So I think their debt mutual funds, liquid funds will still be used for cash management. It's that over 3-year money, that will be impacted.
And it is that money that was really mobilized through big offerings when retail started getting into debt mutual funds, right, Radhika? Because, whether it's Bharat Bond, which you folks started at Edelweiss, or even some of the other funds, the whole attractiveness of debt, mutual funds versus FDs, was the fact that indexation made them a lot more lucrative. Isn't that right?
Absolutely. I mean, look, the whole target maturity fund category after liquid was the biggest debt fund category after Bharat Bond. And the whole story was you're probably 1.5% better than FD on a post-tax or traditional instruments on a post-tax basis. And I really think that movement was just beginning to kick off, over the last 3 years. So, as I said, I am hoping this will be revisited, because we still have some time.
Right. I think although the bill, is up for passing today, Radhika, right?
Yes.
The amended one.
That's what one, yeah.
We'll see. Just one thing, Radhika, from a asset management company perspective, if this were to go through and this category sees outflows, it's negative for asset management companies broadly. But I'm just trying to understand what's the hit in terms of income for AMCs, because lots of them are listed as well. Is it going to be significant?
I I don't think you'll have immediate outflows because remember, existing AUM is grandfathered. I think the questions are large. I don't expect existing AUM to go out. In fact, I think people will retain existing AUM because it has tax benefits, right?
Correct.
I think it's new growth in fixed income that will be impacted.
Yeah, no, absolutely. I think that's a good point. Only after 1st of April, so it's for fresh decisions this does come in. Radhika, we'll keep touching base with you for more nuance on the story as the day goes by. But this is the big one, which Radhika is also explaining to us, which has happened, the big change which has happened. We'll take a very, very quick break here, the first in the program. We are back, stocks to watch out for with our team in just a bit.
Welcome back. So, muted start. That's what the SGX Nifty is pointing towards. Let's quickly take it straight away down to stocks and ITs. One space that we'll definitely watch out for. Rima is joining in. Accenture was the first biggie off the block in terms of earnings and some outlook and guidance. Rima seems to be a bit of a mixed bag.
Yes, so Q2 numbers were actually much better than what the street was anticipating. Revenue growth at 9%. Order inflows, the order wins were exceptionally strong. They've gone up by 17% on a year-on-year basis at record high levels. The problem is the company has tightened its revenue guidance band. So earlier they were guiding for 8 to 11% growth. Now the upper end of the revenue guidance band has been brought down and the full year forecast now stands at 8 to 10%. But what you need to bear in mind that Accenture is a little different from Indian IT. More than 50% of its revenues comes in from the consulting bit, which is seen as pure discretionary. So at a time, at current times of economic uncertainty, the consulting portion of the business gets hit. And even in Accenture's numbers in Q2 or in the order inflows, if you compare the consulting business versus the outsourcing or the managed services business, you would see a big dichotomy. So revenues for consulting have gone up by just 4%, while it's gone up by 16% for outsourcing, which is where Indian IT plays. And even the order booking for the managed services or outsourcing is up 31%. So in a way, I think there are more positives than negatives. And considering that Indian IT has underperformed in the run-up to the Accenture numbers, plus week to date it's down 3%, and Accenture itself was up 7% yesterday, in trade, I would go with a green bias for Indian IT today. Back to you.
All right, a green bias for the Indian IT stocks, but definitely red for some of these asset management companies for the reasons we've been discussing through the morning. Sonal joins in on this debt fund indexation story. Sonal.
Well, yes, it has been discussed completely by you guys already. But yes, let me still take you through the minor details. The news is that mutual fund where they invested more than 35% in equity shares, now that will be deemed to be short-term capital gains. That is what the finance bill is proposing. This applies to investments which are made on or after April 1st, 2023. So what it would mean is that funds like debt funds, gold funds and international funds would be impacted because now all the investments and the redemption will be considered as short-term capital gains. What was the current tax structure? Now the short-term capital gains, they are taxed at the slab rate of any individual, and if redeemed after 36 months, the long-term capital gains was at 20%, and there is an indexation benefit which was available, and that's why there was a favor to these categories as well. Now, as per the proposed amendment, this indexation benefit will go away. They will not be eligible for this 20% rate because it will be as per your slab rate, and grandfathering will not be extended to market-linked debentures as well. We spoke to some experts and they are of the view that while retail investors are not a big category or a big contribution to this category, corporates are, and that is something that could be impacted, and institutional clients, HNIs, they will get impacted if this move actually becomes the final law as well. I got some data in terms of what the AUM for the listed players in terms of debt is. For HDFC AMC, it's 26.6%, UTI AMC at 15%, Nippon Life AMC at 23.4%, and Aditya Birla AMC at 35.5%. So yes, big portfolios which are skewed towards the debt side.
All right, Sonal, thanks very much for that. So many angles to this one, and we'll keep coming back to this. Now, Campus Activewear is the footwear company which has been under immense pressure for a while now, and there is probably more pressure today. There's a block which has been announced. Nimesh, take it away.
Hi, Prashant. In fact, there could be a bit of ease of pressure, so to speak, because it's a clean-out trade from TPG. Now, in Campus Activewear, there's going to be a large block. As I said, TPG is a big seller. So they're selling their entire 7.6% stake via block deal. The floor price is 345, and at that, I mean, the offer size is close to 800 crores. In terms of demand, I believe 60-65% of the book is done, and some large FIs are going to participate. So the execution will be important. But from a supply overhang point of view, it's a clean-out trade. So a large part of the supply seems to be out, will be out after today's block, where TPG is going to sell their entire 7.6% via block deal.
Okay, got that. Thanks very much. We'll watch out for Campus, Nimesh. Back to Sonal. Sonal, why are you watching out for Indigo?
Well, Indigo will be in focus because they held their analyst meet yesterday, and some interesting takeaways where they said that fourth quarter saw a seasonal dip in yields, and this is despite the fact that occupancies were higher for the sector and the company overall this quarter itself. However, they expect this to reverse in first quarter, and they might see strength again in yields in the coming quarter. They are targeting north of mid-teens growth in FY24, so that's a positive number, and they also plan to double their fleet by 2030. Now the growth will come in, they say, not only from the domestic segment, but they are also targeting strong growth in their international segment, which is still not very discovered for them. Management is saying that they do not have any clarity on capacity addition outlook by peers, because that has been a big worry for Indigo, which has the largest market share in the industry. Jeffrey says that while crude has improved their near-term outlook, it's still 40% of the raw material costs, and the other costs are higher, and that's why they have their underperformed rating, also because there are competition concerns for the company. Macquarie says that international expansion will drive the next leg of growth, and momentum will sustain in FY24 as well. And Citi says that current yield trends are fairly healthy if they adjust for seasonality, so they are not very worried and have a buy rating on the stock.
All right, some green expected on Interglobe Aviation. And finally, we have Surbhi joining in with a bunch of stocks that she's been tracking this morning. Surbhi.
Hi, today on my radar is BEL, where the company has received 2 contracts worth 3,700 crores from Ministry of Defence. This is to supply medium power radars and radar warning receivers to the Indian Air Force. Hindustan Aeronautics will continue to be in focus as the offer for sale for retail investors will open today, where they intend to sell 1.75% stake. Now, the non-retail portion of the OFS was subscribed 4.5 times, and the total subscription, including green shoe option, was 2.25 times. The issue price for non-retail investors settled at 2470 rupees per share. And lastly, Vedanta, where they're going to hold a board meeting on 28th of March. This is to consider the 5th interim dividend for the fiscal. Now, Hindustan Zinc has declared a dividend of 26 rupees per share. And if this entire dividend is passed on to Vedanta, the Vedanta shareholders will receive dividend of 19 rupees per share.
All right, we'll watch out for some of these stocks as well. Surabhi, thanks very much. Let's quickly recap the list. Stocks that have positive news flow around them. The Nifty IT Index, of course, all its constituents. Campus Activewear, Interglobe Aviation, Bharat Electronics, Hindustan Aeronautics, and Vedanta. Stocks that have negative news around them today include, of course, the asset managers, HDFC AMC, UTI AMC, Aditya Birla Sun Life AMC, and Nippon Life India AMC. Well, with that, let's move to the commodity cues of the morning as well. We have Manisha Gupta joining in. Manisha, good morning. Happy Friday. What's the latest?
Well, this week has been positive for most of those commodities, especially with what the US dollar index is doing, trading at almost a 2-month lows. So the COMEX gold price is trading at a 1-year lows. Indian gold price is back around all-time highs. And we have seen silver prices trade at a 7-week highs as well. So good going as far as the precious metal prices are there. In the industrial metals as well, we've seen good gains. Copper prices, for one, have gained up by 5.5% in this week on the back of supply concerns coming in from Peru and from Chile as well. And the markets have seen spot premiums increase in China, and that demand really seems quite positive. For the crude oil prices, after 12% of decline in the previous week, this week has gained by nearly 4%. While the Chinese demand is something to watch out for, but here as well, the decline in product inventories in US, the decline in US dollar, and the fact that the US Fed kept pat on 25 basis point of a rate hike, as macros, things have looked quite better for commodities.
All right, Manisha, thank you very much. Good speaking with you, and good to get that perspective. Well, we'll take a very quick break here. Up next, Gurmeet Chadda of Complete Circle Consultants is going to be joining us. He's a top wealth advisor, and we'll ask him about, of course, these changes to debt mutual fund rules. What is he going to tell his investors? And later, we'll also connect with Ashok Sharma, Chief Financial Officer at Greenlam Industries. His Asian Paints Jalaj Dani office sells stake in the company. What's happening there? That conversation also lined up.
Welcome back. You're watching us here on Bazaar Morning Call. Let's welcome our first corporate on the show. We have with us Greenlam Industries. The stock down 25% from its highs. An interesting large trade that took place in the company a couple of days ago where Asian Paints Jalaj Dani's family investment arm sold 2.6% stake in the company at around 306 rupees per share. Ashok Sharma, who's the CFO of the company, joins us now. Thanks a lot, Ashok, for joining in. That really is the first question. Do you have any word from them? They're significant investors of yours, about 10% equity held by them before this large trade. Any rationale on why they would have sold? Is there more supply in the offing? And more importantly, would you be aware of the participants in this deal, the buyers?
Yeah, good morning. Thanks for having me on this show. We don't have any information as regards this. Post this also, they still hold the very significant stake in our company, around 7% they still hold.
Did the promoters buy this?
No, promoter didn't buy this.
All right. Now, the reason why I asked this is mainly because, sometime in June, they were given shares on a preferential basis at around 300 rupees per share, and they've sold half of that at around 306. So could this be a capital protection measure or something?
No, they bought at 309 rupees or so, and prior to this also they were holding 5%. So their combined holding as of now is around 7%.
Any conversation that you've had with other institutional and HNI shareholders? I mean, you do have HDFC, MF, DSP, Akash and Vallabh Bansali, Ashish Dhawan, all of them. Are they also looking to offload any stake in the company? Have you had any conversations there?
Nothing which is in our knowledge as of now.
Okay, so let's talk business then. 2 new plants likely in the fourth quarter, 1 plant in the first quarter of FY24 and another one in Q4 FY24. Is everything on schedule? What kind of revenue addition can we expect from this?
So we are expecting plywood and laminate plant both in Q1 of next year and particle board plant in the Q4 of the next year. Combined total, all these 3 plant or 3 vertical will put together can generate a revenue of around 1500 to 1700 crore over a period of next 3 to 4 years.
All right. And the fourth quarter, how's that gone? Because you implied a revenue of almost 550 crores in this quarter with a 20% revenue growth. Your thoughts on how that's panned out and margins?
Yeah, it's going on as per the previous year growth target, previous quarter growth target, and we will be more or less near to that. I can't comment as of now in terms of the exact figure, but it will be more or less on the target.
Will you be profitable in your deco veneer business in the first half of next fiscal?
We hope so. We hope so that business will turn around. It's turning, and we hope so that we will be profitable in the next quarter.
Is there a chance that it will be profitable in the fourth quarter itself?
Difficult to comment as of now.
Okay, and you've spent what, 325 crores of the 950 crore capex that you had planned. Will you be taking further debt? I mean, I looked at your debt as of December 2022. It's at 150 crores. This compared to 75 crores in September. So will there be more debt taken on by you?
Yes. So debt expansion and debt programming is going on as per the schedule. We are right on the schedule in terms of our expansion as well as the debt which we are taking in this quarter.
What's the debt likely to peak at?
Debt likely to peak at, which will be in the Q4 of next year, is in the range of around 700. Net debt will be 750 to around 800 crore.
And next year revenue target, you hold on to that 20-25% growth, right?
Yeah.
All right. Thank you so much for joining in and giving us all those details.
Okay.
Thank you.
All right. So that is the Greenlam management with, of course, some inputs, of course, on the business and the block trades that happened that caught the market's eye yesterday. Stock 2% higher. We'll see how it sort of shapes up today. Let's take the conversation ahead with Gurmeet Chadha, Managing Partner and CIO at Complete Circle Consultants. Gurmeet, we thought we'll, discuss regular market or maybe some other stocks with you, but or maybe even insurance stocks. But now I have to start with the asset managers, given the headlines that have come in since morning. Now, we don't know. We'll have to wait for the amendments to be finally passed in Parliament. But if this does happen and debt mutual funds lose the benefit of indexation, then how do you see things playing up? I mean, for the category as a whole, and more importantly, then for the listed asset managers.
So clearly negative, Surbi, from what we make out from the first initial impressions we have. The impact to HNIs and family office is there, but the bigger impact is the role funds have played in, financialization of savings, including gold, including, moving money from FDs into capital markets. We do not have a very deep corporate market. That's well aware. And even SEBI has acknowledged the role open-ended funds play, in furthering this. Also, we have at a cusp of huge infrastructure spending, which needs a lot of market borrowing, and banks alone won't suffice. So, in general, the risk assets which are mark to market, get impacted. From an asset manager's point of view, I think the short-term funds would still make sense because those are for liquidity. So, which are liquid funds or money market funds, even arbitrage funds so far are tax efficient. So that also is a sizable portion. So that may not get immediately impacted, but longer maturity does. So these has a lot of long-term, implications in my view. One catch could be that 35% equity thing, which I think something can be maybe worked out. I don't know. You can maybe do arbitrage up to 35-40%. We have to see how it goes. I mean, we'll have to wait for the bill to be passed.
And other categories, Gurmeet, good morning. So there are debt mutual funds then, but gold funds and international funds and ETFs, all of them come under the ambit?
Absolutely. From what the current, whatever I have read, the gold fund, FOFs, everything comes. Hybrid, some of the debt hybrid funds, which are lesser than that category also comes. So we'll have to see, as I said to Santi, I think the first reaction is that you'll also see a surge for next 5-6 days if this holds true because of the last opportunity to get indexation. Also, the older assets, then it doesn't make sense to come out, right? Because those are virtually tax efficient assets which are available for as long as you hold them. So mixed feelings as of now. I think we should wait for more clarity to come.
But Gurmeet, hybrids, I think most of the funds in that category, whether it is conservative, hybrid or balanced advantage, I think most of them are maintaining a little over 35% or in excess of 35% in equity, right? So perhaps they get spared. But I take your point on gold completely. I mean, the gold funds as a category then really lose their shine.
Absolutely, and we want the bond market to deepen, and more importantly, MFs are more on the active side. The other players are more on HTM side. So I think that also has to be taken into account. So it's not just the tax arbitrage part, which is just impacted, which is more short term. So I think we need to see how it goes. Even some of the hybrid funds are that, the old MIP, if you remember, Surbi, used to be 80-20. There are a couple of debt hybrid funds also. Obviously, the sizes. I think the biggest impact also would be on some of these target maturity funds, which has become like a 2 lakh crore in last 1 year. And large buying is largely in, AAA PSUs, GSEC and SDLs, which are the state loans. Also, the Bharat bond, which is actually a government-sponsored one, right? It's again a very large category, 50-60,000 crores.
Right. That's a self-goal of sorts. I mean, if it comes through, I take your point, Gurmeet, because a lot of these target maturity funds were actually investing in, government debt or basically debt of government companies. Manglam?
Yeah, I just wanted to know, from a policy standpoint, now that everyone we've spoken to is saying that this is a big blow, what could have been the rationale? What's the other side of this story? Why do you think this would have come? Is it because they want to deepen the bond market through corporates, or is it because they want to, grow the digital gold offering, which is made by the government itself? Just trying to understand the rationale. What's the other side of this story?
Actually puzzles me, Manglam. Could be the pressure from the PSU bank lobby also, for all you know, because, it competes with long-term deposit. But I think we were coexisting. I think there is obviously pressure on deposits with the way credit growth has panned out. So there could be something of that. Insurance also, if you see the amendment happened, so maybe they want to have a level playing field on, MLDs also, high-ticket insurance also. Let's get the MF also. Something could be more from that. But it doesn't really, I think the risk assets in an economy like us needs to be respected. frequent changes in taxation is not healthy. I mean, you have to keep it stable for long-term savings to go in.
No, got that. But this is positive. Now, how much is debatable, but positive for banks, right? Because banks were competing against debt mutual funds, with debt mutual funds on both the lending and deposit side. So maybe more deposit inflow and more lending as well. Corporates sort of borrow from banks on both deposit and lending side. This seems to be a positive. I mean, just kind of taking stock of as things stand right now and the implication. We'll take a quick break here. Gurmeet, stay with us. We'll get to the markets, individual stocks, etc. in focus. Mitesh Thakkar, Shrikant Chauhan will be joining in with their trading ideas, what to do this morning.
Welcome back. You're watching us here on Bazaar Morning Call. Before we kickstart the trading session, let's get in all the technical ideas in place. We have with us Mitesh Thakkar as well as Shrikant Chauhan of Kotak Securities joining in. Mitesh, good morning. Well, we've been in this range of 17,050 to around 17,200, right in the middle right now. What are your thoughts? Where do we go from here?
Good morning, Mangalam. I think just that, the coordinates, I'll take it slightly differently. Technically, I believe that the broader range could be about 16,800 to about 17,200, 17,181, 200 levels, give and take a few points. So I think this is about a 350, 400 point kind of a range. And, while the intraday indicators are positive, yesterday the bank nifty kind of suffered a big decline. But yet, I think, there are no signs of a fresh declining move starting. So we must assume that the range will remain in force. Having said that, I think the idea should be therefore to try and explore long positions near the lower end of the range, which is closer to about 16,850, 800 levels, or try to explore some shorting closer to about 17,150. With the SGX very flat, I think the index may not offer a good trading opportunity today. But in case we head towards either of the edges of the range, then I think, we'll be looking at taking an index position.
Shrikant, your view?
Yeah. Good morning, Prashant. Good morning, Mangalam. I think, the markets are definitely finding a lot of resistance at each resistance level. And yesterday also, after hitting the levels of 17,000 on the day of weekly expiry of options, we saw a good amount of profit taking or liquidation of long positions. And market closed at the lowest point of the day, which is certainly not positive. Below the levels of 17,000, we can expect further more weakness towards 16,850 or 16,800. But in case if we see any rebound from 17,000, then the chances of hitting 17,150, 170 would turn high. So the strategy should be to look for creating some short positions at higher levels. The reason is because Bank Nifty yesterday fall dramatically from the highs. It closed below the mark of 39,700, which is negative. And there also we are expecting furthermore weakness up to 39,400 or maybe 39,000.
What about stocks, Mitesh? What would you advise?
Morning, Prashant. I have a mix of buys and sell calls today. On the buying side is Aurobindo Pharma. Keep a stop below 479. Look for a target closer to about 500 here. And Colgate, after a big correction, seems to be giving a minor reversal. So this could see some more upside here. Keep a stop below 1505, look for 1550 as the trading target. A sell on Page Industries, which had a negative candlestick yesterday. Intraday charts have turned negative here. So keep a stop about 37,820. Look for targets around 37,000. And a sell on Delta Corp with a stop at 192.5 for targets of 180.
Got that, Mitesh. Thanks for the calls. Shrikant, good morning. Your stocks?
Yeah. Good morning, Surbi. I think, the bank stocks are showing a lot of weakness, and there we can expect further more weakness or maybe further more sell-off during the day. IndusInd Bank is showing a lot of weakness, and there we are expecting stock to fall to the levels of at least 960 or 950. So it's a sale at current levels with a stop loss at 1,045. It is around 1,030, 1,025. So sale on IndusInd Bank. And we like few FMCG companies in that. Hindustan Lever is showing some reversal formation. There we are bullish. We are expecting stock to move towards 2550, 2560. So Hindustan Lever is a buy at current levels with a stop loss at 2450.
All right. Those are individual trades that our technical experts are recommending that you could take. Gentlemen, thank you very much, Mitesh and Shrikant. We'll come back with more in a bit from now. There's 4 minutes to go for the pre-open session. We take a break. We'll be joined by Deepak Shenoy of Capital Mind to discuss the proposed amendments in the finance bill with respect to debt mutual funds. And of course, we'll also speak with an IT analyst, Manik Taneja of Axis Capital, to discuss the Accenture earnings and what are the implications for IT stocks as they open this morning. Stay tuned.